Good morning from London. This is Bloomberg Markets Today. I'm Anna Edwards alongside Tom Mackenzie. With the cash trade just less than an hour away, here's what you need to know. Stocks rise after softer than expected US jobs data revives bets the Fed will cut rates this year. The Israeli military says 100,000 civilians in Rafah are under evacuation order as preparations for a ground invasion move forward. This after Israel closed a humanitarian crossing into Gaza following a barrage of rockets fired by Hamas. Plus, Xi Jinping touches down in Paris to begin a three-nation European tour as French President Emmanuel Macron seeks to reset ties with Beijing.
OK, with an eye, of course, on the geopolitics, we check in on these markets. US futures after a very solid day on Friday, looking to modest gains of 0.1%. So the gains coming through for the Nasdaq up 2% by the end of Friday. The S&P getting gains of a little over 1%. But the context is you're still about 2% off, 2.4% off those March records for US markets. European futures also in the green. We continue to focus, of course, on the currency space. Euro dollar currently at 107. And on the central banks, of course, a big week for the BOE, 107 on euro dollar. Not a lot of movement there. The Bloomberg dollar index up 0.1%. Markets today starts right now.
Welcome to the programme, everybody. It's a bank holiday Monday here in the UK, but it is a trading day as normal in much of Europe and indeed much of the world, although we're a little light in Asia session as well because Japan is closed. So we don't have treasuries trading right now. Of course, futures are trading. No cash treasuries trading until around the middle of the day European time. So we'll look ahead to that. We do have European markets outside of the UK, though, trading today, and so we'll get you set up for your trading day ahead. And Tom, very nice to have you with me this morning as we do just that. There's a lot, as you mentioned there in your markets check, there's a lot of geopolitics to focus in on, and we'll certainly return to the Israel story, which seems to be developing very quickly, very rapidly around Rafah, and we'll certainly get an update on that shortly. With that in mind geopolitically, let's focus on the bigger macro picture, shall we, to start with, and where we've been in terms of the jobs story. US stocks up on Friday, yields down. Of course, the market really quickly jumping on this, what looked like Goldilocks set of data around jobs.
That's exactly how Mohammed El-Erian characterised it, isn't it? So 175,000, so well below the estimates. The estimates have been for 240,000 in terms of non-farm payrolls. They came in at 175,000. The unemployment rate ticking up to 3.9%. But as you know, Anna, of course, the importance as well around the average hourly earnings to see that wage impulse and whether or not that's going to lead to that stickier services inflation. And that came in the smallest increase that we've seen since June of 2021. So again, it seems to all align for a more positive scenario for this Federal Reserve. Mark Cranfield, though, from our own live team saying, don't get heavier skis in terms of pricing in too many cuts, but it seems to build on that relative dovishness that we got from Jay Powell on Wednesday.
Yeah, absolutely. And that was the theme of the week, really, wasn't it? That relative dovishness, muted dovishness, perhaps at the beginning of the week. And then the markets maybe did slightly look to get ahead of their skis, at least by the end of the week, given the softness in that labour market data. So 2 cuts, back to pricing in 2 cuts in 2024 from the Fed. But as you point out, it wasn't just the jobs data that came in soft. It was that US services data that also came in soft. But it's interesting to think about where we are on the overall data picture, because I wonder how long it takes before we start getting worried on the other side of that Goldilocks story about the weakness in the US economy. We looked at the City Surprises Index, and actually it's just ticked into negative territory, and it's been quite a rapid slowdown into negative.
Yeah, so at what point does the cheering around a softer labour market, as you say, start to lead to hand-wringing that this is a labour market that's starting to crack? And there have been some analysts suggesting that a number in terms of the overall unemployment rate of plus 4%, 4.2%, 4.3% is when the concern really comes through in terms of the red flags for the Federal Reserve. And the other question is, to what extent is this a Fed now where the bias is on that other part of its mandate? The bias has shifted from the focus on inflation to the focus on the jobs market. There may be some who would suggest that given the softness we saw on Friday, even as it's characterised as Goldilocks, maybe re-emphasises that if there are these 2 elements at play within the mandate, the emphasis lies on the jobs scenario for this Federal Reserve.
It does, and that's the data side. We've also got, though, of course, the issuance story to factor in. So even though we saw yields dropping, we, of course, are then, there's a test of that yields drop, isn't there, coming? And that's the large amount of issuance that we're going to get this week.
Something like $69 billion US dollars at least this week, which could cap, again, the move lower in yields that we've seen.
Exactly. So if yields are moving lower because people are moving into treasuries on expectation of a slower US economy, well, how does the big supply of treasuries that's coming, how does that push against that? So that's certainly something we focus on. We've also seen some commentary coming around the Japanese story, so we'll certainly move back to that story. And we're continuing to watch dollar-yen, which is at 153.91. Let's move on to the Middle East, because as you were saying at the end of your last programme, Tom, there's been a lot of very quick developments happening in Gaza. We know that Israel is dropping flyers asking Eastern Rafah residents to move out. We've seen plenty of developments around the aid story. Let's get all of the latest, shall we, on the Middle East and bring in Bloomberg's Henry Meyer, who's watching all of these developments as they come in. Henry, where shall we start? Let's start, shall we, at the most recent news flow. Some focus then, rightly, on Rafah and what's about to happen there.
Yes, good morning. Well, of course, this is the announcement that a lot of people have been dreading. 1 million Palestinian civilians who are currently sheltering in Rafah, which is the southernmost point of the Gaza Strip on the border with Egypt. The United States as well, which has been making desperate efforts to try and reach a ceasefire agreement. And, of course, the families of hostages, Israeli hostages who are kept in Gaza, more than 130 of them, many of them dead already, but many still alive, who have been hoping for a deal to free the hostages in return for Palestinian prisoners. So, as you say, things are moving very fast. What we have as of now is an announcement that 100,000 civilians have been ordered to evacuate from Rafah. This doesn't mean that fighting will start immediately, but it's a prelude to an offensive, clearly.
Henry, you touched on those ceasefire negotiations. They were taking place over the weekend in Cairo. We are reporting that they look like they've stalled, and then you have this new change on the ground that seems to be transpiring at a pretty rapid clip. Is this potentially a ploy from Israel to ramp up pressure on Hamas around those talks, or is this ultimately a decision that Israel is moving forward with that attack that they have long touted?
Well, I mean, obviously time will tell, but I mean, to be honest, it looks as though they've made a decision to go ahead with the offensive, which would essentially, suspend those talks. Obviously, there's no chance of reaching a ceasefire in such conditions.
Henry, thanks very much. Thanks for the update, Henry Meyer, with the latest on the developments on the ground in the Middle East. And all of that, you would think, would have an impact on what's going on in energy markets. And so we looked at oil prices, Tom, for any reflection of tensions. What's interesting is the oil price was already moving higher this morning before we started to see Rafah mentioned more intensively by Israel. And we see oil prices up by 0.5%. 83.41 is where we trade. But this isn't just that geopolitics. It's also what the Saudis are doing with pricing and raising their prices, sending oil to Asia.
To those key Asian buyers, of course, as you say, suggesting that they're relatively comfortable in terms of the pricing, the output that currently is coming through from OPEC+. So that is absolutely an element within the oil story. 83.41, as you say, up 0.5%. But this has added another layer to it because, of course, when you look at the conflict now that appears to be on the brink in Rafah, we have to tie in and consider as well the reaction potentially from Houthi rebels, the reaction, of course, from Tehran, and, of course, an eye on Hezbollah, as there are also reports that Israel has hit targets deep inside Lebanon as well. So all of these things coming together as potential risks, of course, for the energy markets as we continue, of course, to take into account the importance of that humanitarian crisis as well. Again, well over 1 million civilians sheltering in Rafah. And again, this is a move that the US has suggested would be something they would be opposed to.
Yeah, absolutely. We'll watch for continued reaction from Western leaders. We're seeing Josep Borrell, the foreign policy voice out of Europe, saying that Israel still needs to grant access to humanitarian aid. So criticising the rockets that were fired at one of those humanitarian aid crossings between Israel and Gaza, but saying that Israel still needs to grant access to humanitarian aid.
Rockets, of course, fired by Hamas. And they took account for that, didn't they? Deadly rocket attack.
Yeah, exactly. And so we'll look for further, as you point out, the scale to be seen of what happens in Rafah, but it has been ahead of any movement, has been flagged as something that various Western countries don't want to see. So we'll see how that develops. We'll look for reaction from the US, from the UK as well, although the UK is closed today, as we mentioned. It is a bank holiday, a public holiday here in the UK. But that hasn't stopped the politics from developing. Friday, over the weekend, plenty of politics to talk about. The Labour Party winning 10 out of the 11 mayoral races that were being contested at the end of last week, including winning in the Midlands, which was a seat that the Conservatives were really looking to hold. And now we brace for what could be another attempt to tack to the right to take on the Reform Party by the Conservatives. Absolutely.
So we heard from Suella Braverman. Of course, she was fired from her cabinet position. She was speaking over the weekend, saying that you do need to take that right turn from the Prime Minister, paraphrasing what she's been saying, but essentially she says this is a Prime Minister that needs to return to those core Conservative values. But to your point around the Midlands, and the hope from the Conservatives that they would be able to hold on, of course, to the West Midlands and Birmingham mayoral seat with Andy Street, who was very popular. That didn't happen. Labour won. Andy Street coming out and saying, actually, we need to be a moderate party. And so it again underscores the tensions at the heart of this Conservative Party as they grapple with that 20 basis point lead that Labour has over them, and then the shellacking they had in these elections. Yeah,
once again, an identity crisis then for the Tories to deal with. The Conservatives, or Sunak particularly, clinging to some analysis that came out of one pollster who was making a translation from these local results into a national poll and saying if the same were seen at the national level, then still concluding, this was for Sky News, this poll, that Labour would be 32 seats short. Now, that is not a conclusion that a lot of other polls have reached, but the Conservative Party, for obvious reasons, are jumping on that one. Others point out that people vote very differently in local elections to the national polls. And then the Telegraph going on to say that autumn is now when we expect to see a vote. The plans for summer, which were never really plans, but we'd heard rumours about, they have been shelved, and now it seems that we're back to the autumn. Yeah, really interesting. So pushing back the time frame, according to that reporting, to the autumn to give themselves more time. But again, it seems like, as you say, that maybe another familiar line of attack from the Conservatives is that this is a Labour Party that will have to do a coalition agreement with, quote-unquote, the dangerous parties like the SNP and the Greens is potentially a line of attack that the Conservatives will start to pursue now. It is, and one that Labour will push back on, no doubt, very loudly. Right, let's tell you what's coming up this week. We've got plenty to focus in on. As we mentioned in our headlines, the Chinese leader Xi Jinping is in France today and will be in Europe throughout the week. He'll also be visiting Hungary and Serbia later this week. We'll get earnings from Aramco, from BP, so plenty on the oil watch. Disney and UBS also in focus. On Wednesday, we'll get earnings from Toyota and Uber in the auto space, then Arm. We also get the US 10-year note auction. We were mentioning that, the large amount of supply coming. And we had the Bank of England's rate decision on Thursday. Friday, we get UK GDP and IAG earnings from the aviation sector. So, I mean, Xi in Europe is obviously going to be one of the big sort of set-piece events that we're going to be following this week. And we have a guest later on in the programme to talk about its significance. Yes, so touching down, meeting the French Prime Minister, and both Macron and Xi Jinping putting out editorials, columns over the weekend in various French newspapers outlining what they hope to get out of this. Really important, of course, for Xi Jinping. Macron saying he wants a reset with China. But as Caroline Connor, our correspondent on the ground in Paris, is saying, Macron is also having to be framed, at least hemmed in to some extent, by what Brussels and wider Europe is thinking about in terms of that relationship that, of course, has become far more tense, with a shift in the view within Brussels as to how aggressive to go on that relationship, pushing back on the trade front in particular. And our guest, who's coming up at 8:30 London time, actually takes that view and runs with it and say, for that reason, it's significant that Ursula von der Leyen is going to be at these meetings with Macron, so allowing that European voice to come through, because it is at the European level that we've seen a lot of that tension play out, whether it's investigations, subsidy investigations into EVs, into parts of the renewable energy space, I mean, medical parts. There are plenty of areas of contest. Whether this visit focuses on those, or whether this visit manages to focus on some of the areas that Europe would like China's support on, like the Middle East, like war in Ukraine, that's also going to be interesting to see. Certainly, President Xi Jinping will be looking for quote-unquote win-win collaboration on areas like climate change. That will be a focus for him, renewable energy. But as you say, this is a remarkable shift in the last few years from Europe in terms of how they position around China. It wasn't that long ago that China and Europe had cobbled together a joint investment plan, an investment agreement that then they ended up ripping up. That was only a few years ago, so the shift has been pretty remarkable. Yeah, the shift is remarkable. And then, so that's going to be part of our programming today. We'll also, of course, dive into the UK conversations this week, because the Bank of England is coming up just later on this week, on Thursday, so we'll look ahead to reading the dovish from the hawkish when it comes to the Bank of England. Yeah, outlook. Bailey has been sounding a little bit more dovish, hasn't he? Can they align with the views around the ECB? Maybe they can go in June, maybe they have to hold a little bit longer. So that's a crucial Bank of England central bank story for us, of course. Coming up then, as we've been discussing, China's Xi Jinping touching down then in the French capital for his first EU trip in 5 years. First one in 5 years. We take a look at what he's aiming to achieve. Plus, Warren Buffett says Apple will remain Berkshire's largest investment despite his sale of a large chunk of his holding. We get the latest from the company's annual meeting. If you have any questions, of course, of your own for our guests, send them to us on IB plus TV Go. This is Bloomberg.
this couldn't have been scripted better. This report runs the tables for a good report.
A Goldilocks report that will please the Fed and please the markets.
This is a good report across the board for validating what we heard from Jay Powell on Wednesday.
People were starting to be concerned that we needed more hawkishness from the Fed. We did not get it on Wednesday. We got a more muted version of what's going on. And I think that this data is starting to prove that out.
Now we're pricing in 2 cuts for the year. I think that's about right.
People were looking for a little bit of a slowdown because they don't want to have to think about rates staying high for much, much longer, and they don't want to think about a hike. They want to start thinking about easing. This puts that back on the table. You've already seen those odds go higher this morning.
I think the Fed would like to get a cut or two in this year, and today opened the door for them to get that done.
Bloomberg TV guests there weighing in on the latest US jobs data and its implications for Fed policy. Let's get another perspective. Samy Chaar joins us, Chief Economist at Banque, Lombard, Odier, and he's with us this morning. We're very pleased to have you with us, Samy. Thank you for being with us. So in the wake of that pretty dovish week last week, dovish from the Fed, a dovish jobs report at the end of the last week, you expect 3 rate cuts from the Fed. Talk us, I mean, did you have that expectation going into last week? If so, you must have been pleased to see that jobs report on Friday.
Absolutely. We fully understand that we're a bit of an outlier here, and we were expecting to remove a cut from our scenario. So we were waiting for Powell to invalidate the idea of potentially a cut very soon. But there he goes, and he basically says everything that we wanted to hear, talking about wages, productivity, the fact that inflation might get back into this disinflationary trend. So there is a very narrow path. We understand it's a narrow path, but there is a narrow path for a July cut. And, we're going to get 3 inflation reports before that July FOMC. We obviously got already a payrolls report. We'll get 2 more. So there is plenty of data to be judge and jury of what might eventually happen in July. And there is this narrow path for a cut if, and that's a big if, but if, we start to see inflation getting back into easing mode.
How weak would the US economic data story have to get, Samy, to justify a cut in July?
I think it's more about inflation than it's about economic activity. I mean, this is the story of 2023. We've seen inflation come down pretty materially without significant growth weakness. So growth can actually be okay. What's important is that inflation gets closer to target. It doesn't have to be at target, but it needs to be closer to target, well within around 2.5, perhaps north of 2.5 range. We're close to there when it comes to PCE. Let's hope that, the wedge with CPI narrows a bit and we get CPI below 3%. But the key here, and this is why we were happy with the payrolls on Friday, the key here is wage dynamics. And they seem to indicate that we'll be able to see lower inflation in the months to come.
And Samy, is this then a Fed where the mandate, when they're looking at the mandate, the priority, the emphasis now is going to be on the jobs component rather than inflation? Is that where the pivot, at least the needle, has swung?
Well, Tom, that was a very interesting answer by Powell, right? Which is, as inflation gets back closer to target, the second part of the mandate basically becomes visible again, right? When inflation is much higher, that's the only thing you focus on. But with inflation coming closer to target, and let's not pretend that inflation is in the high 4th or high 5. PCE is at 2.7, right? So we're far closer to target. Inflation has come down a lot, although it's still too high for comfort. It is closer enough to target for employment to become key again. And very clearly, there is an asymmetry here. The Fed will react more to weakness in unemployment than they will react to stickiness in inflation for sure.
OK, and projecting out to the end of this year then, Samy, you've given us a view on inflation. Broadly, what is your outlook for this US economy?
I think it's a moderately healthy environment. Domestic demand is relatively resilient. This is the story in the US, right? The labor market, and particularly wages, is driving spending. There is spending on services, and that spending on services is obviously supporting services inflation. I think that reality will hold somewhat. We don't expect a huge deterioration in the labor market. And as we don't, there is no reason to be particularly fearful of what happens to consumption. And if consumption is okay, the US economy will be okay. So we do believe the US economy will be okay, but in a context where, as supply shocks recede and as demand gets back in line, there is no reason to fear a significant rebound in inflation. So we do expect moderately healthy economic conditions for the rest of the year.
Yeah, we will see about those supply shocks then, Samy, if they do recede. We just get some lines coming out this morning from Maersk, the shipping business, saying the effects of the situation in the Red Sea are widening. So we'll continue, of course, to watch what's happening there. If I could pivot to what's going on in the UK, Samy, and we get a Bank of England rate decision, of course, this week. We've heard some quite dovish commentary from the Bank of England's Bailey saying there's strong evidence that inflation is receding, but not all members of the MPC sounding that dovishness. Other voices maybe a little bit more hawkish. What's your expectation for the messaging this week?
I think the situation is much simpler for the Bank of England, as for the ECB, by the way, and even easier for the Swiss National Bank than it is for the Fed. I mean, very clearly on this side of the Atlantic, inflation has come down a lot. There is less demand pressure than we have on the US. So, of course, Anna, you're right. Supply pressure can come back and come against the strategy of central banks in Europe. But when we think about the UK, when we look at current inflation numbers, when we look at labor market data, it does open the possibility of a cut in June. Next Thursday, we do expect more MPC members to be in favor of a cut. And if indeed inflation continues to come down very positively as it has in the past few months, there is no reason for the Bank of England to hold a cut in June. So as for the ECB, things are much easier on this side of the Atlantic, and clearly we're running for cuts here.
OK, so Samy, the sequencing that you see then from those three major central banks is June and June for the ECB and BOE, and potentially July from the Fed, which suggests that there isn't that significant divergence amongst the central banks in terms of when they cut rates. To what extent will the BOE and ECB, to what extent does it open the door for sequential cuts? Or will they come through with a cut and then pause, see how things adjust? How much caution will there be in terms of the sequencing going forward?
Well, it's a very good question, Tom. I mean, the economic outlook is pretty decent in Europe as well. It was a very hard 2023, but with inflation coming down below the level of wages, you get some form of rising real income and purchasing power gain, which will allow for a better and improved outlook in 2024 versus 2023. So the growth picture is decent. Inflation is coming down. And the idea is not to go for a full rate cutting cycle. This is a recalibration of monetary policy simply because inflation came down a lot. When you bring interest rates at those levels, because inflation is close to 10%, when inflation goes to, south of 3%, you need to recalibrate policy somewhat. So it's more that we expect a couple of cuts and then they will settle to a more neutral level.
Samy, thanks so much for your time. Samy Chaar, Chief Economist at Banque Lombard Odier, joining us this Monday morning, to talk us through his thinking post the jobs report. We'll bring you coverage of the Bank of England's rate decision and Andrew Bailey's news conference on Bloomberg TV this Thursday, 12 o'clock UK time. This is Bloomberg.
Sadiq Khan has been duly elected as Mayor of London.
An historic third term in the capital for Labour's Sadiq Khan, adding to a weekend of woe for the Prime Minister, Rishi Sunak. The results of England's local election show that the Labour Party is on course to win the next general election, expected to be held later this year. The Conservatives lost over 470 council seats across England. Labour gained over 180. And of the 11 regional mayors up for election, 10 victorious candidates were Labour. The one chink of light for the Prime Minister, the Conservative Mayor of Tees Valley, Ben Houchen, clung on. But down in Brexit-backing Blackpool South, another defeat for the government. The parliamentary by-election there seeing the only Westminster seat up for grabs going to Labour. This was the last major test of public opinion before a general election, which has to be held within 9 months. But so far here in Westminster, the threat of a coordinated move to oust the Prime Minister seems to have receded. Instead, his right-wing party critics signalling they want Sunak to own these losses. and the larger one that's expected to come.
Labour have been maintaining this 20-point lead, and ever since Rishi Sunak, the third Prime Minister of this Parliament, came into office, there's nothing he's done that's been able to move that lead. In fact, if anything, things have got slightly worse.
It wasn't all plain sailing for the Labour Party, though. Signs the opposition is losing support among some communities because of its stance over the conflict in Gaza. Rishi Sunak insists that he is soldiering on. These results, though, suggest the public is hungry for change.
OK, Bloomberg's Alex Morgan reporting on the latest election woes for the Conservative Party. Let's get more detail on this and analysis and bring in Bloomberg's news director in the EMEA region, Ros Mattison. Ros, that package outlines just how challenging this moment is for the Prime Minister, Rishi Sunak. Tie the election results that we've seen over the last 3 days or so to the general election. We know it's going to be called this year, very, very likely to be called this year, and how that could change the thinking around that key vote.
Well, it's always a bit difficult to extrapolate directly from a local election to a national election. People can vote one way in a local election for certain candidates and then vote different at a national election. But there is a bit of a read-through that we can clearly see here, which is that people are turning away from the Tories in general. And they're not just all turning towards Labour. Either they've been turning to some of the other parties on the left, so they don't seem that impressed, with either of the major parties. But certainly there's a strong message that, after many, many years in office, that what the Tories have done, be it on the economy at home, be it the policy over Brexit and overseas, that there is a sort of a sense of frustration and exhaustion, really, on the part of the electorate. And that's got to be a significant cause for concern for Rishi Sunak going into a national election later this year.
Yeah, and one of the reasons why it's difficult to take those local results and sort of extrapolate what happens at the national level is because of all of those parties that get a lot more of a look in at the local elections than they would maybe on the national stage. So with that in mind, it's interesting that some of the loudest voices from the Tory party over the weekend have been talking about the need to tack to the right to take on reform, sort of ignoring the threats from other left parties. But anyway, this tack to the right, we could get more on that this week then, it seems, in terms of immigration and the like.
Well, that's right. It's interesting to see that pressure on Sunak to move even further to the right to differentiate the Tories from all the parties on the left, where it seems like a lot of the undecided voters or the voters who are moving between a bunch of smaller parties are really on the left and possibly, voters that are still up for grabs for the Tories. But instead, they've made the decision, it seems, to tack to the right, as you were saying, and that's going to be statements, comments, particularly around immigration, perhaps curbing legal immigration further, just limiting the number of workers coming in. Of course, that argues the point about Brexit, which is that, as we found out, we do need foreign labour to come and do certain things, and there have been shortages of that in the economy. But that seems to be a point that they're going to press him to make, which is to curb immigration further from Europe, and also perhaps to, really pull out of the European, the Court on Human Rights in Europe.
Yeah, so that's something we'll watch for then. We'll also be watching for the parties to respond to the latest developments in Gaza, Ros, and I know that you'll be following this as well. But we have seen news lines about imminent activity in Rafah, of course, in the last hours. The Labour Party, as we heard from Alex Morgan in that package earlier on, the Labour Party has struggled to get the right note to suit all of its supporters here on this subject.
Well, that's right. And in fact, it's a long-running challenge for the Labour to get their messaging right when it comes to issues in the Middle East, and particularly, again, most recently around Gaza. And we saw some signs that they did leach voters as a result of this in the local elections. And it's been a real challenge for Keir Starmer, not just with the external messaging, but to manage the mood within his own party on it and all the different factions in his party, some who want a very aggressively pro-Palestinian stance, others who are more cautious, and so on. And so it's really got the party tying itself in knots. And so if we do see indeed an offensive in Rafah in the coming days, we see Israel make good on that threat to go in there to that enclave in the south of Gaza. That's really going to be a difficult one for the messaging for Labour. And we can see, that being a real issue for them into the national election also.
Yeah, and of course we've seen a similar issue that has faced the Biden administration in the US as well, in terms of that anger around US support for Israel, in light of what's going on with Gaza, within some communities at least. When we step back and look at what's happening in Europe in terms of some of the political trends, you've got Meloni, of course, in Italy on the right. You've got the Spanish socialists facing a challenge. challenge, very precarious coalition at play in Spain. You've got, of course, the National Front and the strength that's being shown in France, a challenge for Macron. You've got the European elections later in Europe. And, of course, you've got this swing, it seems, to the left-leaning, moderate left-leaning party, in the Labour Party in the UK. And that, of course, could transpire later this year. Is there a broader narrative, a broader theme that we can take from some of these political shifts in Europe, or all these very idiosyncratic stories?
Well, it's interesting because you do see some parties going left, some going right, voters going left and voters going right. And really what it all is about is being populist. You can be a populist on the left and on the right, but what you're trying to do is capture, and really ride what you think voters are feeling and responding to that and really tapping into that. And you can see people doing that, but moving very much further to the left and very much further to the right. We went through a period where we had a lot of parties in the centre. They're really kind of clustering in the centre and very hard to tell them apart. You had centre-left, centre-right and not much difference in between. Now what we're seeing is a lot of daylight between these parties and people going in either direction to try and capture voters. So you do see those parties on the far right still being resurgent in some places. We might see that come up again in the European parliamentary elections, but you also see these parties very much on the hard left.
Ros, thanks very much. Thanks for bringing us the latest. Bloomberg's news director for the EMEA region, Rosalind Matheson, with the latest developments in UK politics. Let's take a broader look at the political space in Europe this week. And we go to France, where the Chinese President Xi Jinping is in Paris as he kicks off a three-nation trip to Europe, his first visit to the region in 5 years. And it's aimed at stabilising ties in the face of mounting trade tensions. Geopolitical themes also likely to get a look in. Bloomberg's Caroline Conan joins us from Paris with details. Caroline, what does the French president hope then to achieve during this visit from the Chinese?
There is a charm offensive here going on. Of course, Macron wants to be the voice of the EU when it comes to trade relations and rebalancing this trade relationship with China. But remember, 1 year ago exactly, Macron was also on a trip to China, and you had President Xi who invited him to the Guangdong residence where his father used to be a governor. So Macron wants to kind of return the same symbol, and he's going to have a very intimate personal touch during the trip, taking Xi Jinping to the Pyrenees mountains in the southwest of France, where he used to spend time as a child. So there is reciprocity in the symbols. Of course, Macron is also looking for reciprocity when it comes to the trade relationship with China. And for that, he's invited Ursula von der Leyen, the EU Commission President, this morning to take part in the talks with Xi during this trilateral meeting this morning. And of course, finally, France also has some economic interest because, of course, France also wants some Chinese investments. In France, they are looking for some investments in the EV battery sector. We could see some announcement later today.
Caroline, what are the key messages then that we expect to hear from Macron on trade with China? And is Macron going to stick to the script when it comes to Europe, or is he going to carve his own path?
Over the weekend, he's already done an interview saying he's calling for a reset of these economic ties with China. Of course, France is being hurt as well by the Chinese flooding the European markets with cheap electric vehicles. There are thousands of them waiting in Belgian ports to flood the European market. And as you know, the EU has started a probe into subsidies into these Chinese EV vehicles coming to Europe. Of course, there is also the cognac probe, which is directly targeting France, because France represents 99% of the cognac market. That was a reaction from China after the EU probe into the EV sector. And for Xi Jinping, the interesting thing is this trip he's chosen to visit France, Serbia, Hungary, which are basically 3 European countries that he sees are more receptive to the Chinese message, perhaps a better attentive ear than the Germans, for example, because Macron has taken a more pragmatic approach of trying to include China in the global trade discussions.
And thinking about what else these two want to get out of this trip, there are, of course, there is the business side, and the investment theme looms large. Chinese investment in Europe has sometimes met with mixed reception. Sometimes it's very welcome, and sometimes people ask questions about it. What's the theme going to be this week, Caroline?
Yes, there is already some Chinese investments in the EV sector in France, but of course Macron is looking for much more, for the size of investments that you saw, for example, with Hungary, because Viktor Orban, of course, is welcoming some Chinese investments. Already there was a €7 billion Chinese EV factory announced in Hungary. And there's also going to be some Chinese investments in a new EV factory in Hungary that's going to be the biggest in Europe. So Macron is not looking to do exactly the same as Viktor Orban, of course, but also taking some interest in the Chinese investments. But at the same time, he has to be very careful, because you heard from the German Chancellor Olaf Scholz when he traveled to China last month that there is this overcapacity of Chinese products in the European market. So he has to really, it's going to be a balancing act between looking for Chinese investments in France and being the voice of the EU.
Caroline, is there any sense at all that Macron could do anything to curtail President Xi and China's support for Russia?
This is really what President Macron has been trying to do over the past year, really. There's been a lot of meetings between French and Chinese diplomats behind the scenes. Macron really believes that Xi Jinping can be a key mediator in the war in Ukraine because of Beijing's influence over Vladimir Putin, even though Beijing, of course, has always claimed its neutrality in this conflict. And interestingly, this week is going to coincide with the inauguration of Vladimir Putin for his 5th term. So we will see if there is a phone call between Xi Jinping and Vladimir Putin during this European trip.
Thank you very much, Caroline. Caroline Conan joining us there from Paris with the latest on Xi in Europe. On other geopolitical concerns, of course, we're closely monitoring what's happening in Gaza today. We've had lines coming out about Rafah and the activities taking place there. Israel, we now understand, has struck the Rafah area from which projectiles were launched. So this in reference to the Hamas projectiles that were fired at one of the border crossings between Israel and Gaza over the weekend. So Israel saying they're taking action in retaliation for that. This was overnight, and this is where the projectiles that hit Kerem Shalom, that was that crossing that I mentioned. Also happening overnight, the Israeli Defense Minister Gallant has said that there was no alternative but to go into this operation, or start this operation in Rafah. We know that the US Secretary of Defense Lloyd Austin had been very concerned about evacuation of Palestinians before any activity took place, so we will continue to monitor response from the West to the current action being taken by Israel. Coming up on this programme, we will get back to some of the corporate news flow that is crossing the Bloomberg terminal this morning. Offers to bail out the French tech giant Atos ramp up with a fresh bid from some of its bondholders. In fact, it received a few bids. We'll take a look at that and some of the other stocks to watch. That's next. This is Bloomberg.
Greg, it's also about access to the game. And here, there needs to be the streaming distribution channels. How are you looking at that?
We are looking at that right now.
What exactly are you looking at? Are you in talks with anyone?
Yeah, absolutely we are.
Give us a sense of who you're in talks with in terms of distribution, in terms of streaming, because there are opinions out there suggesting that perhaps people are not really tuning in and watching live. How do you respond to that?
Well, what's the definition of tuning in? Turning on the TV and turning on the channel 44 and say, okay, I'm going to watch the next 4.5 hours, that's tuning in, right? But to an 18-year-old, to a 25-year-old, tuning in may be 12 seconds on the phone. Okay, let me see this, then I'm going to go back and do that. Oh, and then I'll come back over here and do another 14 seconds on this. Boom. That to me is tuning in. That to me is a market that's enormously wealthy, right? And enormously influential in the direction where you're going. So, look, we are talking to corporations. I'm not going to give you the names of those corporations, of course, but we just did a great partnership with Google.
The reality right now is that there is a great divide in pro golf, PGA and LIV. Negotiations are ongoing. Is a decision imminent, you think? I mean, from your perspective, how are you looking at it? Is it important that there is a merger or not?
Look, I'm just going to answer as CEO of LIV. My boss told me LIV is not going to go anywhere. It'll be well and truly in operation, running well past his death. Now, he's a young guy, so he's asked me just to stay focused and deliver LIV. LIV is a standalone entity. He's invested billions of dollars into this, and we're starting to see the creation of an ROI within this. So we're going to stay focused over here.
That's the LIV Golf CEO, Greg Norman. The full exclusive interview on LIV Golf's plans for the future will run in the next edition of Latitude with Haslinda Armin. That's airing in June. Let's go from the golf to the markets and get to our Markets Live executive editor, Mark Cudmore, who's not on a golf course. He's here in the office with us, well, in Singapore, remotely with us. Very nice to have you with us, Mark. Let's talk about these markets in a couple of minutes. And we had a couple of guests on last week talking positively about Chinese stocks in a way that maybe European guests haven't done for a little while. How excited are you by Chinese stocks these days?
Very, Anna, as you're not probably surprised to hear. Look, this is a theme that I was early on. I talked about it last year about being bullish in Chinese stocks. It was the wrong time. It does feel like the narrative is changing now. So there's a couple of dynamics here. First of all, we know that so much foreign flows have come out. The world is underexposed to this story if it can turn around. And some of the drivers are the fact that the government is providing multi-pronged support. It's monetary support, fiscal support, it is providing reform, and ultimately these stocks are just valued extremely cheaply. And I think you're potentially getting a narrative here where people are going to be slow to buy this bullish narrative, given all the kind of the policy twists and turns from Xi Jinping over the last number of years, given the occasional crackdown in the private sector. It's not where enthusiasm is going to suddenly run away rampant, but you've just got a story which is so discounted that with a number of positives coming in and a national team of buying stocks, it is much easier to start buying a very discounted asset now.
OK, so Mark is positive on Chinese stocks. We take that message loud and clear. From China to the US and treasuries, we saw, of course, the textbook market reaction to a weaker than expected jobs report. We saw yields coming down at the short end on Friday. We now look ahead, though, to a lot of issuance coming this week. How do you expect that to play out?
Yeah, look, I think the big dynamic for the next couple of months is steepening of the US yield curve. So I think that the dovish reaction function of the Fed and that jobs report will help to put a cap on front-end yields in the US. But ultimately, all that supply is going to add to the upward pressure on the long end. And you see that technically. The short-end yields broke their uptrend, the long-end yields didn't. And you're seeing a return to term premium as we do worry about that kind of that supply that is ongoing. So I think steepening is going to be dynamic. We'll see. We might eventually, in the next couple of months, see the end to the longest ever recorded yield curve inversion.
OK, Mark, thank you very much. Bloomberg Markets Live executive editor Mark Cudmore with us to talk about the markets in a couple of minutes. And you can find plenty on these markets from Mark and the rest of the Markets Live team. Globally, of course, MLIV Go is the function to use on the Bloomberg terminal.
OK, let's check in on stocks to watch. Of course, the FTSE 100 UK stocks closed for a bank holiday, but there's a number of interesting corporate stories to monitor and stock stories as we lead up to the open, of course, in Europe. Maersk coming out with some really interesting lines. The shipping company saying the shipping industry's capacity will be reduced 15 to 20% in the second quarter for Asia to Europe shipments because of the rerouting, of course, around and away from those Houthi attacks. And Maersk saying that they are using 40% more fuel per journey and charter rates are currently 3 times higher and often fixed for 5 years. The stock, by the way, is down 12% over the last 12 months or so. And we have to wonder as well whether that tension exacerbates on the back of what we're seeing in Gaza and in Rafah right now. So the line's coming through from Maersk in terms of the shipping impacts from this crisis.
Yeah, absolutely. And really interesting to see whether the market takes that as new information, more detail on what we heard from them just very recently in that earnings report, or whether this is, is it just more information, just more detail, or is it a sort of a change in tack as far as the guidance is concerned. Let's go to Atos. This, of course, is the French tech company, much embattled because of its plight of late. Well, it's received a number of bids. It's received offers to help bail out the company that will frame the discussion with stakeholders around its restructuring. We understand it's received a number of bids from bondholders, from Bain Capital. It's not going to pursue that one with Bain Capital. Also from Daniel Katinsky's EP equity investment and from OnePoint. So there's plenty of voices at play here. This is going to result, we understand, in significant new equity issuance, whoever gets their hands on this business, and dilution for shareholders. So we continue to focus in on that. They have got some interim financing with bondholders, and they're still in talks with the French government.
OK, really important technology story when it comes to France, and we continue to monitor that story. So that could be on the move, of course, at the open, but also the chip makers as well. Semiconductors, a couple of events coming through, a couple of factors to bear in mind. One is what's happening with Foxconn, or Honhai, which is reporting a 19% jump in sales, and this is a company that gets more than half of its revenue from Apple, so suggesting that demand for Apple products is still there. By the way, they still get a lot of demand as well from the AI picture. They're trying to diversify there. And then you've got the lower rates, low yields environment, which could also prove supportive for the tech sector in Europe. So semiconductors on the back of the story out of Foxconn or Honhai. And, of course, that lower yield environment expectations that maybe you could get 2 cuts this year. So maybe a lift for the semiconductor story.
Yeah, OK, we'll keep an eye on the stocks in that sector then. We are, broadly speaking, expecting to see a bit of a bounce at the start of the European trading day. Just remembering what happened during Friday's session. We were stronger across European equity markets in response to that jobs report out of the United States. So to some large degree, we factored that in. But we could see some strong performance still today. US futures point modestly higher for the start of the US trading day. We'll be back with the European Open next. This is Bloomberg. Welcome back to Markets Today. A few minutes to go until the start of cash equities trading. And Tom, we've got European equity market futures tracking a little higher. We are, of course, without the UK market this morning. No trading in London because it's a public holiday. But we are expecting to see a little bit more upside from European stocks, probably still casting our minds back to Friday and the gains we saw post the European close over on Wall Street.
Yeah, so dovish commentary, relatively dovish, of course, from Jay Powell on Wednesday, and then followed up, as you say, by those non-farm payrolls coming in softer than expected, wages also increasing less than expected, and unemployment ticking up to 3.9%, and yields dropping as well. And so you saw that gain of around 2% for the Nasdaq, 1.4% or so for the S&P. Still below the March records, but again, the upside, you did see gains for the week for US stocks.
Yeah, absolutely. So that dovishness in the language from the Fed and in the data on the job side and on the services side, all being taken as positive risk on for stocks in the United States. And we got some of that in Europe on Friday. We saw media stocks going a lot higher. We saw 2/3 of stocks actually in Europe closed in positive territory during Friday's session. But we look for a bit more of that this morning. So European stock futures do suggest we'll be up by around 0.3%, and US futures continue to point a little bit higher, but only 0.1% or so. We've got a number of individual stock names to keep an eye on. We talked about a few of them just before the break, Tom. One of them is Maersk, one of them is Atos, but there's also this layer of geopolitics that we continue to keep an eye on because of the humanitarian side of it, of course, but also because of what it's doing to markets and oil prices tacking higher.
So we watch companies like Total over in France, of course, because the big energy companies will not be trading on the FTSE 100, but seeing, as you say, Brent at 83.60 up close to 0.8%. So there has been that move higher in oil. In fact, the broader commodity space is up so far in the session.
Yeah, absolutely. And just as we've been on this during this programme, we've seen a tick higher in oil. We're up by 0.8% on Brent at 83.61. So that's the commodities space and that's the geopolitics. We bring you then the start of the European trading session without London, so lacking volume perhaps in terms of the European trading day. So no trading in London. We get no trading on the LME as well, and Brent closes early. So there are various things to keep in mind as a result of London being absent today. But we do have other European equity markets trading this morning, and so we can get a sense of where we are there. The CAC 40 yet to open. It looks as if the Xetra DAX is keeping up its end of the bargain, up by 0.2% this morning. There we are. The CAC 40 up by 0.2% as well. So modest gains then, Tom, across these European equity markets.
Yeah, the FTSE Mid currently up 0.4%. So as you say, green on the screen. gain, at least for now, with the caveats, of course. On a sector basis, not a big surprise that energy so far is the leading gainer across your sectors, adding close to 0.6%. Again, the geopolitics, but also the price increase from the Saudis to their Asian customers as well around oil. And as Anna was reflecting on, Brent up around 0.8%, and WTI in similar territory. So energy getting a lift. Autos also gaining as well, 0.5%. We're watching, of course, the meetings between Xi Jinping and Macron. They have not met yet, but Xi Jinping is on the ground in France on a day, by the way, where the French are looking to come to a deal with their autos industry around ramping up the output of electric vehicles. So autos is also gaining as a sector. On the downside, retail and utilities. Healthcare is flat. Retail down 0.3%. Utilities also flat. But broadly, most sectors, apart from those 3 or 4, currently in positive territory. Energy, autos, insurance and tech also getting a lift up 0.4%.
Yeah, tech. You would expect that to go higher if this is about rate cuts coming sooner than we had previously anticipated. There's been quite a lot of volatility, of course, in that sector as a result. And one of the reasons why we saw tech outperformance and the Nasdaq outperforming during Friday's session, no doubt. In terms of some of the individual names that we're watching, we're looking at Müller-Maersk seems to have opened positively, up by 0.7%. So perhaps the market not reading too much into these capacity cuts, perhaps also focusing on the way that, yes, we're seeing continuing tensions in the Middle East, and that's having a continued impact on the Maersk business, Asia to Europe. But perhaps the market focuses instead on what this does to pricing, because when we spoke to the CEO of Maersk just last week, he was talking about, you know, this tension, this geopolitical tension does have positives for a business like this, where we've seen that 40% more fuel on these journeys as they have to go round Africa, but they're able to, the charter rates are currently 3 times higher, often fixed for 5 years. So in terms of pricing, this does produce some positives. Yeah, so do they benefit, as you say, from that reduced capacity? Again, 15 to 20% for the broader sector. Is that a lift for Maersk longer term, as they struggle, of course, with the challenges around the Red Sea? On the tech story then, and just breaking it down for you, you are getting that upside for the sector. It's modest, but you're seeing gains for the likes of Prosus, which, of course, has a significant chunk or stake in Tencent over in China. But also on the semi space, we flagged this prior to the open, BE Semiconductor and ASML, of course, the maker of that lithography equipment, gaining around 0.4%. BE Semiconductor currently up 0.7%, because, as Anna was saying, expectations that you could get 2 rate cuts, but also maybe the lift as well in terms of the optimism coming through from the sales numbers from Foxconn, the maker, of course, of Apple iPhones, and what it tells us about demand for some of that hardware. OK, let's go to from some of the micro stories we're covering this morning to the big macro picture. Of course, last week was a pretty dovish week, dominated by that dovish commentary at the beginning of the week or the middle of the week, from Jerome Powell, and then by the dovishness of that jobs report on Friday. There are still concerns in some quarters, though, about the inflation fight. Let's hear Austin Goolsbee reflecting on first quarter inflation. He is, of course, Chicago Fed president.
We hit a bump for sure at the start of the year on the inflation front, and now everybody's just got to take a step back and try to figure out, is that a sign that the economy's overheating, or is that a sign of some other thing?
Chicago Fed President Austin Goolsbee speaking to Bloomberg TV on Friday and thinking about the trajectory for the US economy. The data certainly giving some people reason to describe the US as back to Goldilocks. Let's talk to Thushka Maharaj, multi-asset solutions strategist at JPMorgan Asset Management, with us this morning. Thushka, thank you for joining us. I mean, Goldilocks, a soft landing, is that your base case still for the US economy?
Good morning. Thanks for having me on. Our base case is for rebalancing in the sense that we see growth moderating through this year. Inflation remains on this bumpy pathway, but we have to acknowledge that the spot inflation rate is higher than we had thought before. And so we're expecting persistent inflation this year. What does this mean, though? We still expect the Federal Reserve to be cutting once or twice in 2024. I think the uncertainty is what happens after that. But I think the data flow in the last week, as you mentioned, is supportive of this idea of that rebalancing, of that moderation in growth. It's too hard to put too much weight on one data point, but the idea that we are seeing some rebalancing in the labor market, I'd say our confidence in that has risen, which in a way supports this thesis that you can see an extension of the economic cycle.
And so, Thushka, with all of that in mind, that's your base case for the US economy. I wonder what that looks like in terms of asset allocation. I was looking at in detail at what Warren Buffett is up to over at Berkshire Hathaway, and he's certainly sitting on a big pile of cash. And some people interpreting that as a call on equity markets and suggesting, well, if Buffett doesn't want to put money to work in equities, then, you know, maybe that gives others reason to pause. What's your asset allocation at this point?
Our current views are pretty positive on risk assets. We still like high quality companies in the US, large cap space. And I think earnings season that has kicked off in the last few weeks has given us more confidence in that view. What I would say, though, is that we are being selective in how we express that view. As you say, beating the hurdle of cash rates is pretty high. We do see policy rates and cash rates coming down over the next few months, but essentially terminal rates will be higher, and so the risk reward of taking risk is different to what it was when interest rates were at policy rates were at zero. That doesn't prevent us from owning risk assets like equities and credit markets, but it does mean being more selective of where that is expressed.
OK, so you want to be selective even as you're relatively constructive still on equities. Thushka, at what point, what would you need to see to turn constructive on small caps, to have the confidence to kind of push down into some of the riskier parts of the equity markets?
Yeah, that's something we've discussed for a while. We can see reasons why you'd have a short squeeze or you'd have technical rebounds in small caps relative to large cap markets. But to be fundamentally positive on small cap, we would either have to see a reset of the cycle, so going back from a mid to late cycle environment more into early cycle, or secondly, a sharper fall in interest rates. And either of those scenarios look very unlikely, let's say, over the next 12 months. And so that preference for high cash flow generative markets is still our main position. But I would say we are incrementally adding cyclicality. We've had a positive view on Japan for a while, and increasingly looking at the euro area equity market as a source of playing cyclical exposure. I'd say small cap is much lower down that list.
Interesting. So how would you fund that exposure to Europe? Would that fund come through by selling down on the US, in terms of your regional bias at this point?
Yeah, so what we've done recently is reducing some of our fixed income or core duration exposure, and that would be one source of funding. The other is parts of emerging markets as well as a reallocation from parts of the US. So you're right, there is a question about how much weight to hold in the US, but I think that still remains a core component of our asset allocation. The choices for Europe are either EM, Japan, and potentially reducing our core fixed income. So I'd say that, you know, the conviction in that has changed in the last week, where we've had that disinflation or that moderation in growth narrative building, and that would support areas like the euro area.
Thushka, can I ask you about M&A as a theme? It's been absent for such a long time, but there are lots of voices now talking very tentatively about the return of capital markets activity. And I wonder what that means in terms of an M&A boom and how investable that kind of theme might be. I know at the Milken conference over in California, this is going to be something that's talked about quite a bit. Do you give that much thought?
It definitely is something that's come onto our radar. As you mentioned, we're starting to see a pickup in M&A activity, especially in the US, and you could argue that that's positive for parts of the smaller mid-cap components of the US equity market. We would say that this is also a healthy sign for where we are in the economic cycle. So looking at it from a top-down macro perspective, this is another indication that we're in that mid-cycle phase where you will see more consolidation. I think it's in entirety more supportive of that positive pro-risk stance, but how it's impacting our day-to-day asset allocation, I'd say that that's more from a top-down perspective rather than security selection.
We're getting a reminder today of the geopolitical risks, given the news flow out of Gaza and what's happening, particularly in Rafah. We're seeing energy prices up, oil prices up 0.7%, 83.57 on Brent, 78.71 on WTI. How do you hedge around these risks? How are you factoring this crisis into your adjustments on the portfolio?
I'd say that this point about heightened geopolitical risk has been with us for a while, and it has become more in focus recently. The main channel through which it affects our macroeconomic view and then our asset allocation is through our oil prices and commodity markets. And as you mentioned, this thesis of having elevated risk premia in oil markets is one we believe in too. And so you expect this the support for the energy sector. Increasingly, we've been looking at sector allocations within our asset allocation, and one of them is a positive view on the energy space within equity markets. We see that both as a view, but also, as you mentioned, it could also be a hedge against certain geopolitical risks. It's not very easy for us to express this directly in portfolios, given the size of our sector allocations. So it also means that our appetite to take risk in general is modestly moderated based on heightened geopolitical tensions.
Thushka, thank you so much for your time. Thushka Maharaj, multi-asset solutions strategist at JPMorgan Asset Management. And on that point she was just making about energy and risk premium in the oil price. Oil price is up by 0.7% today, 83.53, and energy stocks the best performing sector this morning. So that's really where a lot of the action is. Energy stocks are much higher, substantially higher this morning. But let's bring you the sensational six, the core six, some of the big names across Europe and how they're moving. Modestly higher seems to be the theme of the morning, and you see there's a bit of divergence there. LVMH is pretty flat over in Paris, as is Schneider Electric. But Nestlé is gaining, ASML gains, Novo Nordisk gains. And actually that's interesting because at the end of last week, we saw a lot of concern about competitive threats to Novo Nordisk coming from the US in particular. And that was an area of weakness for European stocks as a result. So that's what the sensational six are doing this morning. In terms of the wider movers story then, Tom, we've got Atos in focus. And this is a business that we had been reporting was certainly going to receive one bid, and it turns out it received a number of bids. And so as a result of that, we see the stock is up by 3.8%. It was halted at the start of trade, but actually it's now higher. It received one bid from Daniel Kretinsky and his team. It also received a bid from Bain Capital. It also received a bid from David Liani's OnePoint. They're not going forward with the Bain Capital bid, but that's certainly putting some positivity under that tech stock in Paris. Yeah,
it seems like Atos has some optionality at this point in terms of addressing some of those debt needs and funding needs. On the European shipping story as well, some lines crossing that we marked around from Müller-Maersk around the potential increase, of course, in prices, rates, of course, but also the energy costs coming through as a result of not being able to access that key Red Sea route. And, of course, we continue to monitor the unfolding geopolitical tensions right now when it comes to Israel, Gaza and Rafah. But a reminder of how this conflict has ruptured or at least added significant strains to those shipping supply chains. Müller-Maersk not moving a great deal in the session as we speak, just down 0.1%. Hapag-Lloyd, of course, currently up about 0.1%. Kuehne+Nagel currently gaining 0.4%. So just checking in on that sector. On the chip story as well, semiconductors, we had some optimism in terms of the sales numbers that came through from Foxconn or Honhai. Sales up close to 20%. It's a key manufacturer, of course, for the iPhone. Apple getting more than half its revenue from that company. But also you have the rate story. So markets are putting 2 rate cuts on the table right now on the back of softer jobs data. And so a bit of optimism coming through for the tech sector. You're seeing a modest read across to the likes of ASML and Infineon. ST Micro over in France not reflecting that, though, currently down 0.1%.
OK, coming up on the programme, we mentioned it earlier, Warren Buffett has been active over the weekend, heading for $200 billion. Warren Buffett's cash pile hits a record high. We'll discuss that and other takeaways from the Berkshire Hathaway AGM. That's coming up next. This is Bloomberg.
Welcome back. This is Markets Today. We are 17 or 18 minutes into the European trading session this Monday. Of course, it's a bank holiday here in the UK, but you strip out the FTSE 100, European stocks adding 0.2%. So some modest gains coming through. We have some data crossing from Spain in terms of services PMI coming in above the estimates, 56.2, so well above the level of expansion, well above that 50 level. The survey had seen 55.7, the actual number 56.2 on a composite basis, also modestly above the estimates, 55.7. So suggesting that at least on services and composite, the PMI are looking relatively healthy for Spain. Let's go to the story around Berkshire Hathaway then, of course, holding their annual meeting over the weekend, giving shareholders a glimpse of how the conglomerate will operate without Charlie Munger, of course, passed away last year, but also outlining the holdings, of course, around companies like Apple and what they're going to do with that cash pile. Let's bring in at this point Bloomberg's deals reporter Manuel Baigorri. Manuel, why is Buffett, let's start on the Apple question then, they've downsized their holdings, but Buffett kind of reiterated his fondness for this company. Why is he such a strong believer in a company that many would say is facing a number of challenges at this point?
Yeah, Tom, I mean, as you well said, I mean, it's still a huge holding that he's got in Apple. I mean, and he reduced it by shockingly about $40 billion. I mean, it still remains the largest investment by Buffett, and he's still a strong believer in the company. He highlighted how, despite the sell down, he believes Apple is one of the greatest companies and even better than other fantastic companies like Coca-Cola or American Express, for instance. And he mentioned the iPhone being one of the greatest inventions in history, perhaps. So, I mean, he's been, a believer in the company. I mean, Apple itself has faced quite a few challenges. Here in China, for instance, sales have slumped recently. The stock has been wavering slightly down so far this year. They had a $2 billion antitrust fine as well, among other issues, right? But the company is still steadily, strong, and he believes in the future of the company. So it remains to be seen how the holding will pair over the coming quarters. Keep in mind that the sell down started already a quarter before this one, but it's been a bit more accentuated in this past quarter.
OK, so he's keen to point out his positive views on Apple, even having reduced exposure to it. He's, broadly speaking, been building up a really big cash pile as well. Why is Warren Buffett, why is Berkshire Hathaway hoarding all this cash right now? I mean, it's the size of some European economies, this cash pile, Manuel.
Yeah, definitely, Anna. I mean, it's a whopping $190 billion, roughly speaking. I mean, it's approaching fast the $200 billion mark. It's incredible. But he seems quite comfortable hoarding all that amount of cash. I mean, part of it has to do with the lack of sizable deals. He's done big deals in the past through mergers and acquisitions. We haven't seen a big one from him in a while. At the same time, there is other more kind of like, structural things happening, like high interest rates. There is a lot of uncertainty whether or not they will come down later in the year. Also, inflation remains pretty high, and the geopolitics globally, with the stock market being quite wobbly, he feels quite comfortable hoarding into all this cash for now.
OK, and we'll get a take on whether that has broader implications, what you read into that for equities. We'll get a take from the Markets Live team a little bit later on in the programme on that front. Manuel, thank you very much. Bloomberg's deals reporter Manuel Baigorri. Now, another sector that Warren Buffett watches closely is, of course, the energy space. He has holdings in Occidental Petroleum, and so he will find it interesting that the oil price is up by 0.7%. And, Tom, this is for a couple of reasons, isn't it? There's the geopolitics, which hasn't necessarily played out as it could have done. Last week, there was a lot of expectation that maybe some kind of truce could be reached, at least in the short term. That hasn't transpired in Cairo. So there's that side of things. Then you overlay on top of that what the Saudis are doing on pricing. Yeah, exactly. So the Saudis increasing pricing to their key Asian customers. And then, of course, the risk is that if this is a prelude to attack
on Rafah, then what the broader regional response is to that, and so how you start to price that into these markets, as of course we continue to focus on the humanitarian angle of this. But again, Brent up 0.7%, 83.56. Let's get more then the detail around what's happening to these energy markets and the geopolitical threads into it with Anthony De Paola in Dubai. Anthony, what is your take on some of the factors feeding into the oil moves today, what we should be watching for in the kind of the hours and days ahead?
Yeah, good morning, Tom. Well, this gain today comes after that steep drop-off last week. That was a pretty consistent slide to a weekly low last week. And that's because a lot of that heat from the geopolitical situation was taken out of the market last week. You guys mentioned the truce talks, which seemed to be going positively last week. At the beginning of the week, there was also some talk about a potential defense pact between the U.S. and Saudi that would also include ties with Israel if the Gaza war ended there. So that was some positive news on that geopolitical front. And we've seen roughly a $5 to $10 swing around these kind of geopolitical issues. A lot of people would say that doesn't really price in the real risk that is there, but we did see that then again come out this week. So that's why we're seeing a little bit of gain this week. And we've got that geopolitical situation that we're balancing against all those fundamentals that are feeding into the market, Tom.
And what we hear about Saudi Arabia and their pricing for Asian customers then, Anthony, what does that tell us about the trajectory for oil prices? Is that the kind of development that typically has a long impact, or do we just sort of bounce off that news?
Well, and these things will make the oil more expensive for the consumers, more expensive for the refiners. That's a fact that's been factoring into inflation, which has been a drag on the economy generally so far. But what it does really is it's a show that the Saudis are confident that there's enough demand for their oil, that they're able to charge that higher price. What that also does is potentially it puts fewer of those Saudi barrels into the market. As we know, the OPEC Plus countries are cutting supply to tighten that market. So really what they're trying to get is fewer barrels in there, higher price for it. That increases the cost to refiners, which cuts down on their margins. That also will increase the cost of those fuels going into those final markets. But we are seeing also some concerns about the enduring demand in China and some of the fuel demand. So that's also a factor that's weighing on that.
OK, so China is a factor as well for these energy markets. How do we expect, what is the expectation, what does recent history tell us about how the markets will balance the geopolitical concerns and that OPEC Plus policy?
Yeah, I think we're going to keep seeing this push and pull in the market, where that kind of that $5 to $10 swing goes around when we see new geopolitical developments. But the Saudi cuts, the OPEC Plus cuts, largely led by the Saudis, are going to keep that market tight as long as those cuts remain in place. And they will be carefully watching that market to see when it is time for them to ease some oil back in the markets. Now we're seeing a lot of traders expecting those cuts to continue into the second half. At the start of the year, we were looking at kind of a half year of those cuts and then those easing into the second half. Now we still might see that later in the year, but the expectation is that we've got this slightly weaker, slightly more concerning market. So we're going to keep those cuts in place. That keeps oil off the market, keeps markets tight. So looking for a swing in prices towards the end of the year. And of course, the real question mark is that geopolitical issue, which can cause big price swings in the market to end, Tom.
Anthony, thank you very much. Bloomberg reporter Anthony De Paola joining us there with the latest on oil markets. We'll back to some of the geopolitics and global trade next. Coming up, China's Xi Jinping touches down in Paris for his first EU trip in 5 years. We take a look at what he's aiming to achieve. That conversation next. This is Bloomberg.
Welcome back. This is Markets Today. We are 30 minutes then into the European trading day. To what is happening in France now, with the focus, of course, on the visit by Chinese President Xi Jinping in Paris, landing in Paris as he kicks off a three-nation trip to Europe. His first visit to the region in 5 years is aimed at stabilising ties in the face of mounting trade tensions. Let's get more from Bloomberg's Caroline Connor, who's on the ground for us in Paris, and Andrea Dudek in Prague. Caroline, let's start with you. What do the French hope to get out of this visit?
You know, there is clearly a charm offensive going on here because remember, 1 year ago exactly, Macron was himself in China, received with all the military honors, all the lavish ceremony, and then he was taken to the southern Chinese province of Guangzhou where he had the ceremony of tea with Xi Jinping. Macron is also going to give Xi Jinping the big welcome military parade state dinner at the Élysée Palace tonight. But also a personal touch, taking him to the Pyrenees Mountains in the southwest of France tomorrow, where he spent time as a child. All this, of course, not hiding the issues, especially the trade tensions that we have seen between the EU and China recently. As you know, the EU has opened a flurry of probes into the EV market, into the procurement for medical devices. So Macron said he wants to do a reset of these economic ties with China, and he hopes that President Xi Jinping will be receptive as he is going to represent the EU.
Yes, well, he is, but he's also going to have Ursula von der Leyen alongside, I understand, Caroline. And so how is this trip going to be able to reset that relationship around trade between Europe and China?
So he's talking about this aggiornamento, this reset. But of course, the main issue is with the EV sector. You have thousands, tens of thousands of cheap EV cars parked in Belgian ports waiting to be sold to the European markets. That is something that the president of the EU Commission, Ursula von der Leyen, does not want to see. She's had a much firmer tone than Emmanuel Macron when it comes to trade policies and rebalancing this trade relationship with China. So she's going to be here this morning trying to get the firm message from the EU, balance a little bit the tone with Emmanuel Macron. So there's going to be a trilateral meeting this morning. But of course, the French president also wants some more Chinese investments in France. We may see some announcement with Airbus and some Chinese airlines. We're also expecting something from President Xi about the EV battery sector in France. All this, of course, to try and balance this trade relationship with China.
OK, so that's the France component when it comes to President Xi's visit to Europe. Andrea, I'll bring you in at this point then. What is the rationale? What does it tell us about the Chinese president's priorities that he's visiting Serbia and Hungary on this trip?
Well, if Chinese president is looking for a warm welcome, then Hungary and Serbia definitely have to be on his map, because these two countries, one is an EU member, one is aspiring to become a member of the European Union, have been as welcoming as they can to an influx of Chinese investments that we have seen in the last 5 years. And both President Vučić in Serbia and Prime Minister Orban in Hungary have played a hugely, what they see, a successful balancing act of being on the good side with the EU or being in the EU and yet welcoming investments from China and Russia.
Yes, tell us more about those Chinese investments into Eastern Europe then, Andrea, over the last few years and how they've been received.
They've been received very positively by leadership, by locals. China has invested over $15 billion directly into these two nations. Most of it has gone to Hungary, where China is building huge EV battery plants. And in Serbia, it has transformed the troubled copper mining industry and the steel industry. Chinese investors are also building an upgrade to a rail link that connects the two capitals of Hungary and Serbia, which is seen as a huge sign of belief. It's a huge infrastructure project, and those are always positively welcomed by locals that can also see the presence of China, how it's working. And it raises questions for some people, especially in Serbia, which is trying to become a member of the European Union, whether they actually need to become members and whether, if they see these benefits already taking place and there are more jobs and people are better off and they can take nicer trains, do they still need to meet conditions that the EU wants them to meet? OK, Bloomberg's Caroline Connor in Paris and Andrea Dudik in Prague.
Thank you very much indeed for the detail around President Xi's visit, of course, starting off in France and then moving on to Hungary and Serbia, and the priorities for the French president, for the Chinese president, I should say, and his counterparts in France and elsewhere in Europe. Let's get more detail, more analysis then, and bring in Hosuk Lee-Makiyama now, Director of the European Centre for International Political Economy. Hosuk, thanks for staying with us. Thanks for joining us, I should say. In terms of your take and what can be achieved at a time when the European Union is also, of course, launching this investigation, this probe, as we've been discussing, into Chinese EVs, that as a major headwind, which parts of this relationship can be reset, as Macron would like to see, at least when it comes to Brussels and Beijing?
Well, first of all, I don't think we should look at it as just another Europe-China summit focusing on business and registering complaints over trade frictions and trade surplus. It's also actually a meeting between two permanent members of the UN Council in a very, very unstable world situation, and perhaps the only bridge between the East and West with a common interest in stabilizing the situation in the Middle East and Ukraine. So, of course, there are some business elements, but the number one agenda item is probably trying to see how the leaders talk about how they see the world, not least given the very eventful 2024 we have still ahead of us with the EU enlargement. We have also managing the US, which is also going to be a very central theme with the November elections. So, of course, there is an incentive from both sides to try to get some of the worst frictions out of the way, because you want to keep that policy space in case you are going into a much more, let's say, unstable future in 2025.
OK, so the primacy of the geopolitics versus the trade, at least at this point, when it comes to the meeting between Xi Jinping and Macron and von der Leyen, of course, from the EU. When it comes to expectations in Beijing that maybe France and potentially others within Europe can be something of a counterweight to the US, how valid is that as an aspiration, or has that ship sailed?
Well, I think the Chinese investors and Chinese government take on Europe is a little bit schizophrenic in a way, because first of all, it is seen as a secondary market, the primary one being the United States. Europe contains much less market potential, but it is also the only advanced market they have access to. In other words, there are still a lot of areas, for example, in aerospace. We heard about the Airbus. Chinese airlines ordered about 300 Airbus 320 aircrafts last year, and they are actually looking to sign even more contracts, perhaps already today. And in a number of areas, in capital goods as well as machinery, but also things like consumer goods and agriculture, Europe is a number one supplier to the Chinese market that keeps the Chinese inflation down and the food prices down. So it is a kind of a two-way street where the European leaders, primarily President von der Leyen, as we heard, who will be staying on for another 5 years, which Chinese, of course, are very, very concerned about. And her presidency is largely underwritten by the French President Macron, because, of course, Germany is governed by the opponent of President von der Leyen, the Socialists and the Greens. So to take it as a big picture, I think there will be minor Chinese EU deals, and notably China also want to have, actually they're not so interested in selling to Europe, they're actually more keen to have investment and cash from European capital-rich multinationals, and they want the Europeans to invest more into China. And there's already talks about another factory being set up and potentially even parts of the Airbus aircraft being built in China.
Hosuk, good morning. Back to some of the geopolitics that you mentioned as being on the agenda. What do you think the Chinese response will be if European leaders say once again, just as they've said many times to China, please use your influence to ask President Putin in Russia to change course, to dial back his military activity in Ukraine? How does China respond to that kind of plea?
Well, there has been quite a bit of diplomacy in this area, perhaps hidden away from, both other powers, but also from the media, and where they have been trying to play a constructive role. But Beijing is, of course, severely limited. How I actually like to explain the situation is perhaps Beijing is a little bit embarrassed, of course, by Russia, given the outcomes that we've seen, but their influence is actually quite limited in a way. Let's say Europe's ability to control George W. Bush was quite limited under the Iraq wars. And so, in other words, I think it is perhaps a game that China needs to play, where they have to retain good relationship outwards towards Russia, but at the same time, they are keen to see a ceasefire as soon as possible. We know that market externalities affect the Chinese market far more than the others. China is not that resilient, especially when it comes to food prices and energy prices. And of course, at the same time in the process, they would like to make sure that the US-led world order is broken up. In other words, that there are alternative routes where, economies like Russia can actually survive, potentially fearing their own war in the future for the China.
Okay, so they may continue to reiterate their stance that they want peace talks to take place, but in a way that Western governments wouldn't agree to because of the sort of lacking conditions attached. What about enlisting Chinese support in the Middle East, Hosuk? What would that look like? Is that in any way possible?
Well, China, of course, play a similar indirect role in Iran, and Iran is definitely also part of that alternative network that wants to avoid sanctions and also want to have a more multipolar world, which is not US-led. And I guess that in a sense, also a lot of Iran's or energy export is going to China in effect. So both sides could play both Europe and China could play a constructive role even in this regard. But let's face it, although both China and Europe are, France is a member of the Permanent Security Council of the UN, they don't necessarily hold all the levers, and they have no influence on both sides of the conflict. We are looking at a very existential conflict between Israel and Iran here. So I think that, even the economic tool that Europe and China could use could be fairly limited.
OK. Hosuk Lee-Makiyama, European Centre for International Political Economy Director, with some of the context around this visit by President Xi Jinping to Europe. The first one in 5 years, of course. Next, we're going to dive back into the markets and keep you up to date on what is driving some of the moves in the equity markets. Modest gains currently across the European benchmark. Stock 600 up 0.2%. This is Bloomberg.
This is Markets Today. We're 47 minutes into a European trading day that's without the UK today, so no trading here in London. Elsewhere across Europe, we see modest gains coming through. The CAC 40 up 0.1%, the Xetra DAX up 0.1 or 2. Let us check in on the markets with Bloomberg's Ven Ram from the Markets Live blog, who can talk us through some of the top stories that we're focused on this morning. Ven, very nice to have you with us. Let's go to the post-market reaction to the NFPs. Of course, we saw that received as very risk-on. Suddenly things look more Goldilocks once again, don't they, for the US economy? Give us your view specifically on what happens with treasuries, because I'm really interested in this large amount of issuance we're going to get this week and how that's going to come up against the sort of dovish dynamics that we saw in the treasury market last week.
Morning, Anna. Yes, we got that Goldilocks kind of narrative from the non-farm payrolls report. What that means for yields in the short term is that, if you look at the 2-year rate, it's going to go down to 478. We are not too far off those levels. I wrote pretty much the same thing on Friday before the data, that yields will converge to 478, and that's what seems to be happening. That would be a level that would mark the equilibrium rate for the 2-year, because that would be consistent, by my calculations, with 2 rate cuts. The markets are pricing 48 basis points of rate cuts from the Fed this year. which, if this kind of narrative continues with the economy, with the jobs market, I think that is possible. So 478 would be the rate for the 2-year.
It's also, of course, a big week for the BOE, the decision coming on Thursday, Van. As you look ahead to that, is this a Bank of England that can kind of chart its own course now? Do you expect that message to come through from Andrew Bailey and co on Thursday?
The Bank of England is very keen to send home the message that, look, inflation in the UK is very different to inflation in the US. So they've been pivoting for some point, for some point of time towards rate cuts. Whether or not inflation will afford the scope for them to get there is a different thing. The crucial metric that the BOE is watching will be the April inflation data. They're pinning a lot on the data point to show that inflation is converging to 2%. If that happens, yes, the BOE will get some headroom. But the point is, what happens to inflation after the April print is the question. I expect a touch and go around in terms of inflation, meaning it may kind of bottom around those levels, but then it's not going to stay there. And that's the key message for the BOE. So if you think about it, beyond the short term, the headroom for the BOE isn't a whole lot to cut from here.
OK, so that's the view on the Bank of England. That'll be topical later on this week. We've also had over the weekend news developments from Berkshire Hathaway. Then, Ven, I know, you can watch this at the micro level, or you can try and read some macro signals in it. And here we have Berkshire Hathaway sitting on a cash pile that is, frankly, the size of a European economy, equal to the GDP of a sort of modest-sized European country. Do we take from that they don't have a very positive view on stocks? They can't find opportunities to invest in? What do you think of this development?
Absolutely nailed it, Anna. I mean, that's exactly the view that Warren Buffett has been touting. Over the weekend, he spoke to shareholders and he said that, look, we want to deploy a lot of money, but with very little risk. And investors seem to be forgetting the latter part, that about very, very little risk when they are investing successively at higher levels in US stocks. If you look at the S&P, it has surged more than 30% in the past year. If you look at the NASDAQ 100, it's done almost 50% in the past 1.5 years. I mean, those are kind of very lofty valuations, promising a lot. But, it's not based, you don't invest based on a promise, you invest based on performance. And that's the message from Berkshire Hathaway's growing cash pile, that investors shouldn't forget about valuations.
OK, don't forget those valuations. A key message coming through, of course, from Warren Buffett at that annual meeting. Bloomberg MLI's Ven Ram, thank you very much indeed on the equity market ramifications of what we've been hearing, of course, from Berkshire Hathaway and Warren Buffett. Meanwhile, of course, Ven touching on and giving us a preview and setting us up for that key meeting from the Bank of England. And we're going to bring you coverage of the BOE rate decision. It's on Thursday, of course, and Andrew Bailey's news conference on Bloomberg TV. It is this Thursday. That's from 12 p.m. UK time. Let's get back to the issuance story in the US then, because this caught my eye, this Treasury chart showing just how much the US Treasury is set to issue this week. And again, it's something that Ven touched on. It's something Anna touched on at the top of the show, which is in an environment where towards the end of last week, particularly on the back of the meeting that came through from the Fed on Wednesday, and then, of course, softer jobs data, you saw a significant move, particularly into the front end of the Treasury curve with yields coming down. But to what extent that move is capped by the fact that this is a Treasury that is issuing significant amounts of Treasuries and notes into these markets, and to what extent the market can absorb that. So just this week alone, $67 billion combined of 10 and 30-year Treasury securities, but also $58 billion of 3-year notes as well, Anna.
So a bit of a test of that lower yield story that was certainly taking hold and regrounding itself, re-emerging last week as we saw some dovish commentary from Powell and then that pretty dovish print in terms of the jobs report on Friday. So that's the story around Treasuries. Interesting to think about where we are in the Eurozone economy as well. We've had a number of guests this morning, or at least one stands out as suggesting they're considering loading up more on European stocks. And interesting to see some of the data outperforming this morning. This is not new information necessarily, but an update of what we already knew about some of the strengths developing in the European economy. economy, or recovery maybe. But the French PMI data on the services side coming in higher than had been expected at 51.3. And that takes the composite to just over 50, which is, hadn't been expected. We were expecting to be at 49.9. And these sort of strengths, these tentative signs of strength in the Eurozone economy, really interesting to watch as we wait to see whether we get that rate cut in June. Much telegraphed, much looked ahead to, I suppose, for European investors.
And how much of this is a change in terms of the narrative around US versus Europe? If you have a more constructive fundamental story when it comes to Europe and the growth picture looking a little stronger in Europe and inflation continuing to head in the right direction, we continue to hear that from ECB officials. They're pretty confident that inflation is on track versus what we're seeing in the US, where arguably things are a little softer on the economic side from a higher base, but also inflation stickier. And to what extent that becomes a narrative later this year.
Yes, and we heard from the ECB's Lane. He was talking to a paper, I think, over in Spain, saying don't exaggerate the impact of that ECB-Fed divergence. So we keep those lines in mind as we think about that, and views on that differ, of course. Let's tell you what else is coming up then today. We have, or this week, in fact, we have the Chinese leader Xi Jinping in France today. He extends, of course, his trip across Europe, in particular to Eastern Europe, later on this week. Tuesday, we get earnings, including from Aramco and BP. We get Disney and UBS earnings that day as well. That's tomorrow. Then on Wednesday, we'll have earnings from Toyota and Uber in the sort of transport space. ARM also reporting. In the US, we get that 10-year note auction that we were just discussing. We also get a rate decision from the Bank of England, and on Friday, UK Q1 GDP and earnings out of IAG. So interesting that Ven Ram doesn't think that the Bank of England has much room to manoeuvre. We've had slightly differing sort of sentiment coming through from Bank of England officials, it was seen, with some sort of quite dovish lines coming through from the Bank of England governor, Andrew Bailey, perhaps, talking about what he expects to see on inflation, but other voices sounding a little bit more hawkish, perhaps.
Yeah, Andrew Bailey making it clear at the IMF that the inflation dynamics in Europe, and he included the UK within that bucket, are very different to the inflation dynamics in the US. But yes, he does, to your point, he has to deal with the hawks, of course, in the MPC, who up until the most recent meeting were still, two of them at least, calling for an increase in rates. They held at the last meeting, of course, they've reduced their hawkishness, but to what extent those particular members of the MPC are going to be needed to be convinced further that inflation is indeed heading in the right direction here in the UK. As maybe the GDP data out later this week as well is going to show that we are out of recession. Yeah, absolutely. So look, waiting for that UK GDP data. We've got January and February, so you've just got to add in the March number, so we'll get that clarity on that recession story that you mentioned. And interesting that we spoke to Samy Chaar earlier on in the programme, and he was saying, to that point about some BOE MPC members really quite recently calling for rate hikes. He says more and more of them are going to be lining up for cuts. And he's expecting that the UK looks a bit more like the ECB, doesn't it? It looks more like Europe rather than the Fed, which comes later with its cutting. Yeah, if you had to push him and to arm twist him, he'd say, I believe, ECB June, BOE June, and then the Fed coming through in July, potentially, with 3 cuts from the Fed. And he's saying, with the caveats, but that was his view, potentially 3 cuts at this point, as the market's pricing 2. Yeah, and I think that, yes, exactly that. The base case for markets is that we get less on all fronts and later than his estimate. But anyway, interesting to get his views, and interesting that he had a good week last week because his view around the Fed was reinforced by the weakness or softness, I suppose, of the jobs creation numbers out of the United States. That is it for markets today. The Pulse is up next, of course. In terms of where we are on European stock story, we're up by 0.1%. No London. It is a public holiday today here in London, so we don't have any trading. That means we won't get LME trading as well. Brent trading ends early, but we do see a higher oil price, and that is putting upward pressure on stocks. So those stocks open in the rest of Europe, of course, and trading. And we do see energy as one of the biggest gaining sectors this morning, up by 0.7%. The Pulse is next. This is Bloomberg.